Let's do a full example of the first in, first out or FIFO method of how to fill in an inventory card, except for inventory write-downs, which we'll deal with in the next chapter. So our business is Super Socks. They sell business, casual and sporting socks. They use the perpetual inventory system, which is the only method we'll cover, and that just means they use inventory cards and they record transactions immediately, and they're going to use the FIFO method, and it also means they'll do an inventory count on a regular basis, which for them is going to be on the last day of each month. So what is first in, first out? Well, first of all, remember it's just an assumption. It's never going to be right. Probably unlikely to be right anyway. We just say it's an assumption that the first items in are the first items out. This may not be true, it's just an assumption. And why do we do it? Because it saves us a ton of time and effort and money having to identify each actual unit, which we do with the identified cost method. And we should use this for things that are faster moving that sell a lot, that maybe are perishable, like food, it's a good one for foods, are physically smaller, so it's harder to keep track of, and maybe for things that are identical, no way to physically differentiate or identify the units. Now these socks here are all quite distinctive, but let's say all the socks we sell are black, and maybe they just vary in some little way that's really hard to tell. Well, it's very hard to identify each of those. So this is a great system to use for this type of product. So let's start with all our rules. So first in, first out. Well, we teach you first in, first out, but it's not really the first in, first out method, because we can see there's actually some exceptions to that. So you've got to know your rules. So this has to be a cue card that you make for yourself. What we're going to do is just take one each one as we get it, and we'll just deal with it when it pops up. So let's start with the first one. The following information relates to the Sweet Socks model, and it sells for $20. That should say $2 GST, not 20. But that's going to be important, that selling price, because we might need that number to determine how many units we sell. So the first one, it says 1st of April, opening balance of 25 units costing $8 each plus GST, and 30 units with a cost price of $7 per unit plus GST. Well, the first thing we should always do is go, why are they telling us about GST? Just to confuse you, because GST should never ever go on the inventory card here. So when we do an opening balance, we put the date, we write the word balance, and then we skip the in column. Don't put it in the in column because it's not coming in. We're just saying it's already there from last month. So we go straight to the balance column. And the order we were given, it said 25 at 8, so we would assume that they were the first ones in, so they're going to go on top. 25 at 8 is 200, and then 30 at 7 is 210. So that's how we enter the opening balance. On the 3rd of April, we had a cash sale of Sweet Socks made for a total of $340 plus $34 GST, receipt 607. So for sales, under the FIFO system, we'll just assume the first one in is the first one out. So we've sold $340, but we don't know how many units that is, and that's why we need to know the selling price, because earlier on it said these sell for $20 each, and if we sold $340 worth, well, that's 17 units. So we've sold 17 pairs of socks. So we put the date, 3rd of April. We write here on the details. We never write like cash sale or the customer's name. This details column really should just say document number. So just always put the document number. So, which 17 pairs of socks did I sell? Well, in reality, I have no idea. And that's what's good about the system, is I don't even need to know. I don't care which 17 they were. What I will assume is that the 17 must have come from this pile here. So I've got 17, because they're the first ones that were in, they'll be the first ones that are out. So it was 17 at $8. So if I had 25 at 8 the day before, 17 are gone. Well, that leaves me with 8 pairs at $8 for a total of 64. And these $7 units are still there. 7th of April, we purchased inventory on credit from Funky Feet of 40 units for $9.90 each, including GST, invoice F187. So we start with the date, and then we put the document number on the details, invoice F187, and again, we just got to get that GST out. We don't want any GST here. So the $9.90, we've done GST, we divide by 1.1, and we'll get $9. So that's 40 units at $9 for a total of $360. And all we do now is we put in the ones from the day before. They're still there. So these $7 ones, we're just going to put these $40 ones, these $9 ones, 40 units at the bottom of the pile. Not literally, they won't be in nice neat stacks like that out the back, but we're just assuming that because it's going to be really easy to keep track of inventory this way. On the 8th of April, Super Socks donated 10 pairs of socks to the local basketball club in return for product promotion, MOS4. So that's what we call inventory use for advertising. So when that happens, we just assume the first one in is the first one out. Here's our inventory card as it is from the day before. So now we're going to donate 10. So we start with the date, you put the document number, which is memo S4. So, which 10 pairs did we donate to the basketball club? Well, we don't really know, but what we will assume is that the first 8 pairs must have been these ones, because they were there first. So we'll say the first 8 out were at $8, and that must mean the next 2 came from the $7 pile, because we just go straight from this one to this one. So we'll say 2 at 7 for 14, and we can see 8 and 2 is 10 units, which matches this. So what does that leave us with? Well, the $8 ones are gone. So they're not going to show up here. We had 30 at $7, but 2 of those are gone. So we say we've got 28 at 7 for a total of $196. And these $40 units at $9 are still there. On the 11th, we made a cash sale of 20 units of sweet socks, receipt 621. We just apply FIFO for sales of inventory. So we got our date, we write document number, receipt 621. Which 20 units? We will assume that it must have come from the ones that were first in, which is this 28 units at $7. So we'll say 20 of those are gone. And that must mean if we had 28 the day before and 20 are gone, we've got 8 pairs left at $7, and we've still got these 40 pairs at $9. Now in reality, that's not the case at all. If we actually looked out the back in the shop, it's very unlikely that these would be the actual units left. But our life has been made very, very simple, because look at the volume of transactions. We're selling a lot of units here. And yeah, what that means is it's very hard to keep track of. So we'll just use this system. 15th of April, 6 pairs of sweet socks taken by the owner as drawings. Memo S5. We learned in a previous chapter the owner is allowed to withdraw their capital in whatever form of asset they want. Usually it's cash, but it can also be inventory. So that means in this system we do first in, first out. So we do the date, 15th of April. Document number, memo S5, and we will assume that the 6 pairs of socks that the owner took were from this $7 pile. So 6 at 7 are gone. So we had 8 at $7 the day before. 6 are gone, so that must mean we've got 2 units left at $7, and we've still got this 40 units at $9 here. 19th of April, cash purchase of inventory from Funky Feet of 50 units for a total of $500 plus $50 GST. So we always get the GST out. We don't want nothing to do with that in the inventory card. Here's our card as it was, and then we're getting 50 units for 500. So what we need to do is just a little bit of maths. We'll do 500 divided by 50. That must mean each unit, so we'll do 19th of April, check 9. Each unit that came in was $10 each. So we've got 50 units at $10 is 500. So that number there should match this number, which it does. And then we just bump everything up one. So we say 2 at 7 there, 40 at 9 there, and then we just put these $10 ones at the bottom of the pile there. 50 at 10 for 500. 23rd of April, credit sale made to TQ Coach of 7 pairs of sweet socks, invoice 411. So for sales, we just assume first in, first out. Here's our inventory card. Now we're going to sell 7 pairs. We will assume the first 2 pairs that this customer grabbed were these 2. So we'll do 23rd of April. Invoice 411, we'll assume the first 2 that went with these 2 at $7. So all the $7 units are gone. Now, this customer bought another 5 pairs because it's got to come to a total of 7. So we will assume the next 5 pairs came from this $9 pile. So we'll do 5 at 9. And that must mean these $2 ones are gone. The $9 pairs, we had 40 the day before. 5 of those are gone. So we've got 35 left. And these $10 units, we've still got 50 of those. And that's all been pretty straightforward so far. All the transactions under the FIFO system have actually been first in, first out. But now we're going to get some more difficult ones. Because what happens when that customer from the day before, TQ Coach, returns 6 of the pairs of socks purchased on invoice 411 back to us at Super Socks? Because the thread had started to unravel. So they're faulty. And this customer was granted a full credit off their account for $120 plus GST. Now, we don't actually need this because that's the selling price. So in the inventory card, we don't actually need that part. What we do need to do, though, is remember with the sales return, we're going to reverse FIFO until all returned, then move back to the previous price. That's really confusing to understand. What does that mean? Well, let's look at our inventory card the day before. So the day before, we had this customer came in and bought 2 at 7 and 5 at 9. So that was a total of 7 units. Now, that customer's only bringing about 6, not all of them. So which 6? Well, we take the ones, we reverse FIFO. So in our FIFO world, let's say this customer, as they took each unit, took it to their car one at a time. So they took this one at $7 to their car, then they went back into the shop, took the next one went back in the shop, they took one at $9, went back in the shop, took another one at $9, and so on. So what we're going to do is reverse that. So literally, we'll start with the date and the credit note. The last 5 units that that customer brought or took from the store that are coming back in were the $9 ones. So we'll assume they're the ones that are going to come back first. Now, the problem here is, if we look at that, we're left with 35 at $9 here. That's what the balance is. The most we ever had of this was $40 units at $9. So if 5 come back in, we had 35, 5 have come back in, we've got 40 of these again, but we never had more than 40. So what we do is we kind of go back to the previous price now. So what we'll say is the 5 units that came back first were $9, that's them. And what's really important here is, even though they're coming back in first, we don't put them on the top line. We've got to put them on the second line. It's a bit stupid, but that's just the way they want us to do it. So the customer brought back 6. What would the 6th unit have been? Well, we'll just go back up to this pile here and say the customer must have brought back one of those ones. So the customer took 2. We'll assume the 6th unit they brought back was one of those. And we can see here 1 unit and 5 units. That's a total of 6, which equals this. So what just happened? Well, the day before, all the $7 units were gone, but 1 came back. So that sits there. We've got to put them back in FIFO order. So the $7 units came in first, so they go back on top. We had 35 at 9. The customer brought back 5 of those, so they've got 40 at $9 left. And then 50 units at $10, they're still sitting there at the bottom of the pile. That is probably the trickiest transaction we could get. Maybe an inventory gain under FIFO. But that's really hard. But the rule is reverse FIFO until all units returned, then move back to the previous price. 25th of April, Super Socks, that's us, was able to repair 3 of the faulty pairs of sweet socks that the customer returned. So they can stay in inventory, they're fine. But we could not fix the other 3. So what we did is we returned them to Funky Feet for a credit of $27 plus GST, credit note F18. So that is what we call the purchase return, and the cost there is determined by the supplier on the credit note. Here's our inventory card. So let's just look at this story here. This customer came in on the 23rd and bought 7 pairs, and we just assumed it was those 7 there. Then the customer brought back 6. So we said the ones that came back in were these ones. Now what we're going to do is on the 25th of April, we're going to send them back. So there's a credit note F18. We're going to send them back out, but only 3 of them, because we said we could fix 3 of them. So 3 of them are going to stay in inventory. They can just stay over here. But the other 3, I guess the question now becomes which 3? Well, in this case, we don't apply FIFO. So we don't say 1 at 7 and then 2 at $9. What we do is we say the cost is determined by the supplier. And what the supplier said was you're going to get a credit of $27 and you're returning 3 pairs. So 27 divided by 3 is $9. So what we're doing is we're sending out 3 units at $9 for a total of 27. So the supplier said we're going to give you a credit for 3 units from this pile here. So what are we left with? We have 1 at 7. That's still there. We had 40 at 9, but we're sending 3 back. So now we've got 37 at 9. And we've still got 50 units at $10 there. So that's another little tricky one. So under FIFO, we don't actually apply FIFO for a purchase return. The cost is determined by the supplier on the credit note. Then at the end of the month, an inventory count was performed and showed that 83 units of the sweet socks were on hand, memo S6. So we've got the rule for an inventory gain, which is use the most recent value from the in column. And for an inventory loss, we just apply FIFO. So we need to figure out what the case is. So if we look at our inventory card there's a lot of info, but all we do is we just go to the most recent balance, and it says there should be 1, 37, and 50. That's a total of 88. That's what should be there. But it says the inventory count said 83 were there. We have lost 5 units. So we are going to deal with this situation. And what we do with it under FIFO with an inventory loss is just assume the first one's out. The first one's in with the first one's out. So if we've lost 5 units, we'll say the first one was this one at $7. And then the next 4 units we lost must have come from this 37 at $9. So we'll say 4 units at $9 went out. What does that leave us with? Well, the one at $7 is gone. We had 37 at 9, so now we take out 4. So that must mean we've got 33 units at $9. And we're just going to leave these $10 units, the 50 at 10 there. And what we should see is that our final balance here is 83 units. That should match up here, the inventory count here, which counted 83 units. And so what we've got there is an inventory card completely filled in using first in, first out, and that is every single possible transaction that we could get until now. We just need to add in something called an inventory write down in the next chapter, but for now, that is as difficult as it could possibly get.